Hello and welcome to yet another edition of Prime Time Live. Uh, Talking to the research folks at PrimeInvestor. My name is Srikanth Meenakshi. I am a co-founder at PrimeInvestor. At the outset, let me first apologize. I know my lighting is very poor here. It was a last-minute snafu. I couldn't do anything. But thankfully and fortunately, I will not be doing much of the talking, so this should not be a problem on an ongoing basis. So please bear with me as we go through this. We live in terribly interesting times. What's happening around the world? I mean, just as we were recovering from the COVID pandemic, or we were beginning to recover from the COVID pandemic, we have been hit with this pretty terrible war in Ukraine. The, the human side of this event is pretty catastrophic and very sad. Us in India, we can sympathize with what's going on in Ukraine and other parts of that part of the world. But we need to live with the impact of what is happening over there as well. An event such as this, it is a geopolitical event, and it has ramifications and impact all around the world, especially to our finances, especially to our economy. We are here to talk about that um, uh, impact and what we should be doing in this context. We are also going to be discussing a couple of small case portfolios that PrimeInvestor recently launched. Um, to get started, let me set the frame and bring in Vidya Bala, our head of research, and ask her a simple, at the outset kind of a question. Vidya, when a geopolitical risk such as this manifests, how should investors look at the market to understand what's going on? And what does it mean to the broad equity market around the world, especially in India? I should say. Mute.
Thanks, Shrikant. Good evening, everybody. Thanks for joining on a Saturday evening. Like Shrikant said, we are living in interesting times. I mean, the last couple of years of COVID has had enough ramifications on our lives, on the economy, and these stock markets. Strangely, the COVID seems to have given a booster to the stock markets rather than the other way around. But unfortunately, a war-like situation, a geopolitical risk cannot be termed in the same manner. And as you would have known, the reaction by the market last week was, enough proof of what the market thinks about such a risk. Um, so Nifty, our own markets, are off 12% from their highs in January. But if you take the individual constituents of, say, the Nifty 500, the larger universe of stocks, or for the matter, the NSE itself, so over 1,000 stocks have fallen, 20% in our markets. So that is the kind of, impact that we are seeing from their highs. So what are the risks now? And should we be worried about it? So that's the question. Definitely, when such a geopolitical risk happens, risk on assets naturally will see some jitters. And these days there are more risk on assets than equities, which is your cryptocurrencies and your NFTs. And I'm sure any extended risk can shake these unproven segments of investing. But as far as equity is concerned, definitely it is a risk on asset class. And the Indian markets VIX, the volatility index, the fact that it has shot from 24, 25 to about 32 on the day of the sharp fall is indication to how the market is jittery. So but the good news is that India's earnings currently appear to be very strong. In fact, they appear to be better than estimates if we go by the latest, December quarter earnings. So that is a very consoling or a very sound factor for India. And I think that will stand us in good stead. And I don't mean that there won't be a correction, but it can kind of prevent a very deep or a sharp correction, because end of the day the fundamentals, the earnings would matter to the markets. So we do think that this risk right now, there aren't big ramifications, but what could go wrong? Yes, if things get extended, obviously, without needless to say, the oil is already shot up, and this could have significant ramification on our deficit, on our own imports, and very 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 importantly, inflation, right? And inflation, a trigger for interest, something that the RBI has been trying to control, not raise interest rates, that could go out of sync, because global inflation can really hurt based on oil and other imports that we would be dependent on, supply chain issues. These are things that will be matters of real worry if this situation extends. But we hope, we really do hope that, given how the global, I mean, the countries around have been reacting, that this will not be a very long event. Nevertheless, a correction, and a correction on the face of strong earnings is always an opportunity, right? So, so these are the worst of times for the human race, but these are also probably the best of times in the market. So that's what I'd say. Vikas.
Thank you, Vidya. And now let me bring Bhavana into the picture as well. And hi, Bhavana. Uh, so, in this kind of market situation, like Vidya laid it out, right? How should the investor react? I mean, what are they? How are they supposed to handle these gyrations, and what should their reactions be?
Yeah, so like Vidya was saying, there are so many factors that are at play. Even apart from the geopolitical risks, there are multiple factors that can affect the market. So, the first thing investors should do is to brace for volatility. They should expect corrections and not be spooked every time the market falls and be worried about their investments and all that. So, the first thing is to be prepared for volatility. The second thing is, not to panic and start exiting your equity investments, right? Because that's like one of the worst things you can do, to start selling because everyone else is selling. If we do get into a corrective phase, what our past experience has told us in every bearish phase like this is that it is the best time to start building up, or continue building up your equity portfolio, especially if you're a long-term investor. I mean, not the trading, but if you're a long-term investor and you're trying to build your portfolio, phases like this offer good market opportunities. They offer good buying opportunities. If you take the broad market, this, even if the Nifty would have fallen only 12%, there are so many stocks that have fallen much more than that. So the index will tell you one thing, but there are so many other stock specific opportunities that have come up in the correction, even over the past, like, say, 4 to 6 months. So this is actually the time, it's time to be accumulating, right? If you take the Nifty 50 value, if you just take the PE, right, the peak was somewhere in April 21, where the consolidated trailing PE was about 34 times. That has now come down to 20.8 times if you take the PE, trailing consolidated PE. The average typically has been about 18 times if you take the history. So we are not that far above average. So, and markets have typically bottomed out at about 14, 15 times PE. So all these go to suggest, along with the earnings pickup that Vidya was explaining, all these go to indicate that this is the time to be accumulating equity uh, your equity positions. Now, how you do that kind of depends on where your risk level is. If you are, more conservative, if you're more moderate, then you don't take a very aggressive approach. You take a more balanced approach. You invest in phases. Don't take very high concentration. Don't take highly risky bets because you don't know how they're going to turn out. So you be more gradual in your approach. But if you're an aggressive investor, if you're a high risk investor, then these are great times for you to pick up those individual stock opportunities that you might have had your eye on. it is a good time to see where stocks are at good discounts, where their fundamentals are still strong, where their earnings can pick up, where their growth potential is, still strong even post COVID, right? So this is for those high risk investors. They can start getting more aggressive, especially very sharp market falls like we saw a couple of days ago. Those are good times to just put money in that short list, or in that set of stocks that you would have had on your watch list, or that you were tracking, or something like that. So if you're more conservative or moderate, be more balanced. If you're more aggressive, go for specific stocks which you had your eye on.
Thank you, Bhavana. Now, turning back to you, Vidya. Um, Bhavana spoke about specific stock opportunities that are available out there in the market. And at Prime Investor, we have done something pretty interesting, something that we've been wanting to do for a long time, and that's launch of two small case portfolios, and one portfolio, the first portfolio that we launched, the financial disruptors portfolio, is specifically about looking at those stock opportunities that are available in the market in a very promising sector, in a very a high interest kind of a sector from a investment world point of view, right? And so the financial disruptor portfolio is a very unique portfolio that is there in the small case pantheon of portfolios. I mean, there are a few hundred portfolios in small case. There isn't one like the financial disruptors portfolio that we have launched. Can you take us through what is great about this portfolio? Why we did this, and what it means to be a financial disruptor, and whether this is a good time to get into that area. Can you please talk to that?
Sorry again, right? So Bhavana was talking about having a moderate risk appetite or a high risk appetite when it comes to picking, I mean, investing in these times. Our financial disruptors portfolio fits the high risk appetite bill for those who like to pick stocks and opportune times, and pick the right themes at the right time, right? So that's where this financial disruptors shall I just start presenting the portfolio and also
Yes,
explain? Yes,
please go ahead.
so that will help me explain your the concept better.
Yeah, please.
Can you see the presentation?
Yeah,
Okay, I'm on so my presentation is on the screen
correct.
entirely, right?
Yes.
Okay, so in any economy, and any economy is fueled by credit growth by banks. So this is why I mean, it's no surprise that any large index will have the banking and financial service as the largest sector exposure. And this has been the case for very long, that banks, I mean, the economy has been driven, so banks typically grow twice, 2 to 3 times what the economy grows. But the last couple of years has seen, actually the last few years and more intensely in the last couple of years, we have seen credit from banks to industries and service sectors decline. I have data here from RBI that says between March and December 21, credit just grew by 4.6 percent. It had at its best been in double-digit growth, in the periods of 2005, 6, 7, and all of those. And even the money that goes as deposits, and your money that goes as deposits to banks is basically sitting as government bonds. It's sitting in investments made by the bank, just part of their SLR, the statutory liquidity ratio, and it's not really being given as borrowings. Why has this happened? Because we have seen in the past, in fact, it was post 2008, and then again post 2000, 16, 17, 18. we have seen a large amount of NPA buildup, and banks have become risk averse, because they've already taken a lot of hit in their balance sheet, right? So banks, which fuel the growth of the economy, aren't really growing in terms of credit growth, right? So then why even talk about financial sector, right? Um, the important thing here is, I'm sorry. I just want to go to a different slide. You will see the performance of banks, the returns that they have given. Obviously, all that, the NPAs that they have taken in their books, and the fact that they have not lent is showing in terms of the returns. You can see that their performance has not been great. On the other hand, the financial services, which includes NBFCs and other, have done better than the banks. You will see from the Nifty Financial Services, that the performance has been good, right? So now I spoke about, coming back, I spoke about, that credit has been bad. So where did banks go to? Banks then didn't lend to industries and services, and they moved to the retail space. So they're trying to do really well in the retail space, but unfortunately, the fintech thing happened, and there was a lot of disruption. Whether it was digital lending apps or NBFCs offering payday loans or gold loans, MSME loans, micro, and these small finance banks, the amount of smaller lending that they were giving in tier 2 and tier 3, all of this meant that banks were seeing severe competition from areas that they did not have competition from for a very long time, right? So this was happening on the lending. So they were moving from industry and service lending to retail lending, but there was competition there, right? And how about deposits? When your ICICIs and HDFCs were offering 5 and 5.5, there were other small finance banks, there were NBFCs offering extremely competitive deposit rates. Many of you would know at 6% or 7%, the rates are very, very high, right? So this is the kind of returns that, there's a kind of deposit interest that they were getting to kind of shore up their CASA. So there was intense competition for large banks, the universal banks, on the deposit side as well. Right? And this is where the story comes now. We are looking at the universe of stocks in the financial space that are causing a disruption to the traditional banking system. When I say this universe of financial stocks, it can include banks themselves. Banks themselves may be disrupting the way of doing business, right? So we do think the traditional way of lending, the traditional way of taking deposits are all being kind of challenged by newer ways of lending and doing business. And our job, and that's where the growth is going to come from, because banks are not lending, so somebody else is lending. So somebody else is taking that part of the market and doing the job. Who are they, and how are they doing? And are they growing fast? Are they having a quality balance sheet? Now, these are the things that we are looking at. And are they enabling this disruption? Are they participating it in some way? And how are they going to go about doing this? This is the universe of stocks that forms part of our financial disruptors portfolio. Have the universe here. We have NBFCs, not all NBFCs, but those that have built, very niche models, whether it is in retail lending or small business or digital lending, who have created a niche for themselves in any, certain segments of lending. Microfinance institutions, which go to the under-penetrated market, where banks, other than probably your SBI, banks have hardly, touched that part of the, market. Mid-sized banks that have been very early on in terms of tying up, through for digital means of doing business, or partnering with digital platforms and so on. Small finance banks, obviously, who have either digital tie-ups or different means to source their CASA. You heard of many small finance banks tying up with many of these apps just to get deposits, right? They are not going about doing their own investing, but trying to get deposits from these digital apps. And then rating agencies. Why do we think of rating agencies? When banks aren't lending, what have companies been doing? They still need money. They are raising commercial papers, they are raising NCDs, they're raising bonds. Where is that? From the debt market, right? So there are many enablers of the debt market. These could be, depository services, these could be rating agencies. These are all enabling a more vibrant debt market, taking away what the traditional banking system was doing earlier. So that's disruption for you. And then we have AMCs. Banks are also doing, the business of also, wealth management, etc. And AMCs have been kind of AMCs that are very innovative in terms of wooing investors from the traditional deposit. And the amount of SIPs that's going into the mutual fund, market, etc. today. So SIPs are literally competing with deposits, and it could be any other enablers of this new way of financing or borrowing or investing, right? They could be platforms, they could be exchanges, they could be depositories, etc. So that's the universe broadly. And within that universe, our job here is to look for growth, high growth, right? So when we say high growth, it's one important thing to note here is, I said, when we think of disruption, it doesn't mean bank themselves can't disrupt. They may be able to disrupt, but we have very intentionally left out large banks, not because they cannot disrupt. A lot of banks that have adopted digital ways very, very well, but because they probably can't grow at a very fast rate like the smaller ones would, right? So that's the reason. So our thing is being able to disrupt, and the outcome of it should be high growth for us. So we are looking for those kind of stocks. Obviously, we don't want very small ones, so we have kept a cap of the market cap of 1,000 crore and above. We have a whole lot of filters that I discuss further here. If they are banks or NBFCs, we have these filters. If they are other financial sectors, we look for high quality balance sheet and we look for high growth, right? So we don't compromise on the quality of the balance sheet and the growth here. So valuation is important, but it is not the most important thing, simply because we have said this is a high growth portfolio. So in a high growth portfolio, we don't want to miss out on opportunities just because the stock is a little highly valued. And please remember, markets such as these do offer opportunities to even get those high growth stocks at good prices, right? So our financial disruptor portfolio is a very compact portfolio right now of about 10 stocks. There maybe here, a couple of stocks here and there when we change, but it will largely be concentrated. It is, the stock weights are capped at 15% individually. Obviously, they will grow and we may resort to rebalancing based on the need to do so, depending on how much the stock has run up and its potential. So the weights are based on the caps that we have internally set ourselves for sectors and for stocks. So as you will see right now, the NBFCs is a very broad category that I have given. There are niche segments within NBFCs. We have those stocks there. That's about a little under 30%. We have banks, not large banks, other banks that we think are causing disruption now to traditional banks. That's about a fifth of the portfolio. We have small finance banks. That's about a fourth of the portfolio. And then we have other financials, other sectors that I discussed about. That is under 30, but that's about 27% of the portfolio at present. So this is just a very compact, tight portfolio of stocks that have actually, currently, as you will know, many of the banks and financial stocks have underperformed, and they are actually underperforming the Nifty. I mean, so if you want us to talk about the portfolio per se and its performance, currently they are underperforming the Nifty. It's because they are completely, out of favor in the market. Many of them have been cleaning up on their NPAs. Many of them are just beginning to turn around and grow, etc. And we think this is the time to actually go behind those stocks, because we do know they have a sound, quality, sound balance sheet with them. As far as the portfolio rebalancing of this, financial disruptors is concerned, we will resort to quarterly rebalancing. We will review them quarterly, but there may be ad hoc changes if there are any, specific events with the company that we have in the portfolio. Those can also trigger rebalance. We will resort to booking profits on stocks that have moved beyond our comfort zone in terms of valuation, or where we think suddenly the potential has reduced. And because this is a very, very new space, we are looking at the future of finance, right? We will definitely have, as you will all know, we are already having stocks that are getting listed, coming through IPOs, etc. Where we think there is potential, and those new entrants show, very importantly, clear sign of growth and a quality balance sheet. we will be considering them as entrance into this portfolio. So that's broadly what I have in the to talk about the financial disruptor space. Um, Two things here. One, most of us tend to go behind traditional banks when it comes to stocks, or if you buy a mutual fund portfolio, you will have most of the portfolios loaded with banks, right? Now this portfolio can actually counter, if you are holding a portfolio or a set of mutual funds with high weights to banks, this can counter the, it can kind of complement those portfolios, simply because we are challenging those, right? Obviously there may be some mutual fund portfolios with which do have some of the stocks that we will hold, but our thesis is that we will challenge the key index stocks, the traditional banks, right? The key index bank stocks. So to that extent, it can well be a complement to even an existing portfolio of mutual funds or stocks that you might have. So that's the broad thing about the portfolio.
Thank you, Vidya. The point that you made at the end about the complementary nature of a portfolio is a very important point, and I hope listeners took note of that. Um, with that, let me turn to Bhavana, and this is not the only portfolio we launched. We also launched a very interesting ETF portfolio. We don't want to leave the investors with a slightly lower risk tolerance, in the lurch, and we have a specific portfolio for them, and it's a very well handcrafted portfolio of ETFs that follows a particular strategy. Okay, let me not preempt what you have to say. So please go ahead, take it away, Bhavana. Thanks.
Yeah, so like Shrikant said, we are not leaving, we are giving portfolios across the risk appetite scale. So let me just start presenting. Sorry. Okay. See.
And while you are setting up, Bhavana, folks are asking questions, which is fantastic. We will take your questions. We'll answer as many as we can at the end of these couple of presentations. And please keep them coming. We may not be able to get to every one of them, but we'll get to as many of them as we can. Thank you. Yes, please go
Yeah.
ahead.
Okay, so I'm assuming everyone can see the slides. So
Yeah.
the second small case portfolio that we have is the what we call the core and satellite ETF portfolio. So unlike the financial disruptors, which is thematic and stock only, this is a ETF only portfolio that is a little more diversified, right? So let's start with understanding what a core satellite approach is. Traditionally, a core satellite portfolio combines the benefits of index-based passive investing and a more active approach within an asset allocated framework. That is, your portfolio gets split into two, right? There is one part which is the core, and this will consist of your index funds, that is the passive investment that represents the market itself. The second part is the satellite, which is made up of the higher risk active funds, the thematic funds, sector funds, direct stocks, bonds, all that, right? So this is how a typical core satellite portfolio works. Now, what we are doing is to take this and put a slight spin on it, right? Now, how we are doing that is primarily we are taking the underlying concept of a core satellite portfolio, which is that you're taking the broad market for basic returns that are in line with the markets, and then you're trying to generate alpha using the satellite, right? So you have a stable core, and then you're adding high risk, high return options. So we are doing two things like this. One, we are not following an asset allocated approach. Right? This is not an equity debt portfolio. This is an all equity portfolio, which we are going all equity to maximize returns. The second thing is that we're using only ETFs for the satellite. We're not using stocks. We're not using no active funds. Nothing. We're just using ETFs because if you take the ETF space, For a long time, the only options you had was in the Nifty 50, the next 50, and maybe a few banking ETFs. But over the past few years, what has happened is the ETF availability, the options that you have slowly gone up. So if I can just show you, for example, over the past 2 decades, the number of ETFs that you have really increased, not just in number, but in terms of variety also. So you have other strategy ETFs, you have factor-based ETFs, you have more themes, you have more sectors and all that. So it's perfectly possible to uh, catch different market opportunities, catch different sector opportunities through ETF themselves, without having to go to active funds or without having to go directly to stocks. Right? So that's the concept that we are using in this core satellite, where we use like a stable core made up of market cap based indexes and a satellite that is made up of more strategy thematic indexes. Right? So when you take the core, okay, the aim of the core, like I said, is to benefit from the collective market movement, right? Because you're earning what the market does by investing in market cap based indices, you're earning what the market delivers. You are to that extent limiting the risks of taking wrong calls, right? So the core becomes the foundation of your portfolio, like where you go with the collective wisdom of the market, you don't take any unnecessary risks. So the options in the core portfolio, the indices that we're actually looking at, uh, are the market cap based indices. When I say market cap based indices, those are indices where, for those who don't know, where the stock weight is dependent on it's determined by its market capitalization. So higher the market cap, the higher the stock weight. So market cap based index investing is a time tested strategy, right? There, in market cap based investing, you're taking no judgments on which sector will do well, which strategy will do well. Your exposure to stocks that rally are automatically going up, your exposure to those that are correcting are automatically coming down. So there is a lot of benefit in simply going with the market. Now, when I say market, I don't mean only the Nifty 50. I also mean, when we are looking at the core, we are looking across market capitalizations, right? So we'd have mid caps, we'd have small caps. We'd switch around between the, say, if markets are rallying, we might increase the mid cap allocation, or go to the Nifty 500, or if it's correcting, you reduce the risk allocation to the smaller market caps, and so on and so forth. So we will be investing across the market capitalization in the core, and that is what the rebalancing will involve. Like, we rebalance every quarter, so it will involve increasing weight to some index, or removing one index, reducing weight to another index, all of that. But while we are doing that, because the core needs to be the low volatile, so we are going to focus, large caps will be the focus of that particular core segment. What we are also doing with the core is to have some allocation to gold. This is, I mean, we are not taking a call on gold or anything. This is just some hedge to equity, because this is a non-equity portfolio. So we are not having debt and all that to balance the equity risk. So just to smooth out the volatility of the portfolio a little bit, we are using gold. Right? So it will not be a big part of the portfolio. It is just there to hedge the equity. The satellite is where we will be trying to boost the returns of the portfolio and actually deliver that alpha over and above the market. Because remember, the core is going to deliver more or less what the market does, little bit more, because we are investing across the market curve. But the satellite is where we are going to actually deliver the extra returns that you need to make. When it comes to the satellite part, there are two purposes for the there are two ways, two aspects to the satellite portion. One is obviously, to play the sectors or themes that are available. So whether it is taking a sector call and say IT will do well, or pharma will do well, or banking will do well, or whether consumption will do well, themes. So that is one part of the satellite where the aim is to capture those specific sector opportunities. The other part of the satellite, the other aim of the satellite is to diversify away from the core. By that I mean we will look for indices that will behave differently from the core while being broad based. For this, the set of ETFs or indexes that we'll consider are the factor indices. Now, these are not like your market cap indices. Your market cap index, like I said, takes the stock's market cap as the weight. In a factor index, it would take the score of the stock on a particular factor as the weight. Right? Now, this factor can be volatility, it can be alpha, it can be value, momentum. There are lots.
Bhavana,
Yeah.
can you try without your headphones? The audio seems to be pretty choppy on your side.
Oh yeah. Okay,
Yeah.
hold on. Is this better?
Let's see. Please go ahead.
Okay, right. So, sorry, where was I? Yeah. So the first set of
Sorry.
ETFs that we consider, are the factor-based indices where the weight is dependent on the score that the stock has on a particular factor and not its market cap. So how a factor index is built typically is that you take a traditional market cap based index, and then there are scores that are applied on those stocks, and then the stocks that score the highest on that particular factor make up the index, right? So therefore, these factor indices provide something different from the traditional market cap based indices, from the parent index it draws from. So it could serve different purposes. It could contain downsides. It could help deliver on upsides. It can help pick up market trends, like if value is doing well or if quality is doing well, and so on. Right. So that is what we're going to use the factor indices for. And the other part, like I said, is the sector thematic, auto, manufacturing, consumption, all of that. So this satellite portion is going to be far more dynamically managed than the core. The core also will be managed, but the satellite is going to see a lot more change in either the weights or the indexes, which is what the rebalancing will involve, right? Because we have to pick the opportunity as and when it arises. So there might be a lot more change, like introducing a new index, reducing the weight, removing an index, and so on. What we may also do in the satellite is move into cash if we have an internal algorithm that indicates cash calls that we may need to take based on market valuations and all that. So if our indicator says that it's better to move to cash, we may take liquid ETF. We may include liquid ETFs in that index, but it is still primarily, this will be temporary when we do it. So it will still be primarily only in all equity portfolio. It is not going to be your asset allocated portfolio. Now, how do we come up with the list of, I mean, how do we draw up the portfolio or figure out which index needs to come into that? It's sort of a two-stage process. What we do first is to work out which index actually needs to be included. Now, just because an index is there doesn't mean that it's automatically worth investing in. Some indexes may not even deliver what the Nifty 50 does. So the first step is to see how the returns of that index pans out, how it does in different market cycles, how its returns compare to the main Nifty index. Is it more volatile? Is it less volatile? Does it do well only in certain phases? Does it do poorly in other phases? And factors like that before we decide that this index is worth investing. So once we arrive at that, the next step is to look at the ETFs that track that index. because, and this is important, I mean, even if the index is good enough to invest in, that doesn't automatically mean that the ETF is good enough to invest in, right? Because if its tracking error is high or its volumes are low, then it's not going to be a worthwhile investment, even if the index itself is good. So obviously, tracking error is a very key factor we look at, not just against the underlying index, but also how much the market price of that ETF deviates from the NAV. Because that gives us an indication on how efficiently the AMC is managing the ETF, whether it's able to create units on time to meet the demand, is it able to manage the demand supply. Those factors the tracking error will tell us. But what's also important, especially is in all the sector and thematic ETFs, the tracking error may be under control, but sometimes the daily volumes are not very strong. So that makes it the practicality of investing in it becomes slightly difficult when your volumes are low. So even while it scores on tracking error, if it's low on turnovers, low on volumes, then it gets difficult to invest in. So that's another factor that we look at. So essentially, it's a two-step process. Find out which index is good enough to invest in for that particular market by looking at its performance, and then looking at which ETF within that index is worthwhile an investment. Now, when we back tested this portfolio, we have gone very far back because some of the strategy indices are new. But if we take the rolling 3-year returns over the past 3 years, so that's a 6-year block, the core and satellite portfolio beats the Nifty 50 TRI by almost all the time. Right? We're taking the Nifty 50 because that's the easiest market to be investing in. That's representative of the market. So, and it's actually a hard index to beat. So this core and satellite beats it almost all the time on a 3-year basis. And the average extent of our performance is 4 percentage points. And not just that, it contains downsides better. So if you can see, the minimum returns is better in the core and satellite portfolio. The volatility is slightly lower, which automatically means that your portfolio risk adjusted returns is higher, which is an indication that following this core satellite approach not only helps you beat the market, but also helps you contain the volatility. So if we break the returns down into, you take the return distribution, the proportion of times or the number of times in the whole period where the Nifty delivered more than 12% annually was just 55%, but the core and satellite portfolio delivered 12% plus returns, more than 80% of the time. So this basically shows that the combination that we are working with actually helps deliver market plus returns. So this is simply from Jan 2017, the index versus our portfolio. We just charted this performance. So to put it in a nutshell, what this portfolio is all about. One, you lower your risks, you earn what the market delivers across the market cap curve. You lower your risks by going with the collective market wisdom. And because even in this market cap allocations, because we keep changing the weights, the volatility is better controlled. So one benefit, you earn from what the market is doing, you don't take unnecessary risks there, you still keep volatility under control. And on the other side, you get market plus returns. You get to participate in segments where there is opportunity without having to take stock specific risks or having to take concentration risks, right? So you get that specific set of opportunities also. And because we tactically manage this, you always shift to where there is opportunity. And finally, because we try and we may be taking cash calls, or we may be shifting to opportunities like indexes like low vol, So even during market corrections, it will, to the extent that a non-equity portfolio can do, its returns is also, its downside containment is also, you get all of that. And finally, obviously, if you, because you're investing through ETFs, it's a lower cost that you're managing. So that's pretty much what we are doing with the core and satellite. It's basically to take a stable core as the foundation, just simply invest in the market in that core, and then use tactical allocations across sectors, across opportunities, even international, to get that higher return over the long term. Like, this is a long term portfolio, it is not a short term portfolio. It, you can even use it for your, you can earmark part of it for some of your goals, right? So long term, uh, it will suit any investor, whether you're moderate risk or high risk or low risk. It is your stable part of your entire investment. But quick alert, I think I saw this in the as a question in the comments also. If you're a Prime Investor subscriber, you will get 30% discount on the on both portfolios. So this offer will close in a week's time. So do subscribe if you haven't yet, and if you want to take advantage of this. Just log into primeinvestor.in/small case to see the coupon code, or you can write to contact at primeinvestor.in. So,
Right. Thank you, Bhavana. Thanks for mentioning the discount and the coupon code. Yes, there have been some questions about it. So let me ask a couple of questions to you guys, and in the interest of time, let's keep the answers a little fast flowing, so that we can take as many investor questions, viewer questions as we can as well. So the first question is, Vidya.
Yeah.
There are, I made a brief mention earlier, but there are so many small ETF portfolios, small case portfolios out there. What makes these portfolios different in its own right? Can you just quickly talk about that?
Yes. So, distinct factors for financial, disruptors portfolio. You would see regular banking or financial services portfolio out there. We are challenging the traditional theme, right? So we are going to pick those that are going to be the future, right? So I don't think you have. So we are the most unique portfolio in small case as far as this theme is concerned, and it's a very compact portfolio and it's very competitively priced. That's one financial disruptors with ETFs. It's not just a bunch of ETFs from a single AMC or a mutual fund, right? It's a concept. Typically, a core and satellite. Core is active. Core is passive and satellite is active. We decided you should get the benefit of low cost for your entire portfolio, and we decided we will have a portfolio, a part of which will be somewhat actively managed, and that's the whole idea of having a core and satellite portfolio. So it's not just an equity debt portfolio or a general asset allocated portfolio, none of those. This is at present, an almost all equity portfolio with some possibly allocation. We may take cash calls there. So it's a very actively managed low cost ETF. It's a kind of an oxymoron, but that's what it is. Yeah. And again, very attractively priced, given the fact that it's just not simply something that you just buy and don't do anything about. There will be activity there too. So.
Okay. And Bhavana, there are a few questions, and there is something that we want to touch upon as well. About small case allows you to do both lump sum and SIP investments. Between these two portfolios, is there one that is more suited for lump sum SIP versus the other? What's your take there?
So the core and satellite portfolio would be more suited to SIP investments, because it's a diversified portfolio. It's invest in a bunch of ETFs, and it's a long-term portfolio that you can earmark for your goals and all that. So the core and satellite portfolio is more towards SIP and less towards lump sum. But the financial disruptors actually would be more suitable for lump sum investments, especially in market corrections. You just deploy some in it. But especially if you have a bigger amount, don't just make one lump sum investment. Use market corrections to capitalize on those lower prices. Make multiple lump sum investments.
Okay. Thanks. I should also mention that Aarti Krishnan wrote a very good article on our site about why SIP in stocks is not a great idea in general. Viewers can search for that article and read that article as well. Um, there is let me take some investor question, and one general investor question. I mean, Bhavana, you mentioned about the coupon that is available for our customers. But the question is, with respect to in prime growth, we have prime stocks, we have stock recommendations, and we have these small case portfolios. Vidya, probably you can answer this. What is different between the stock recommendations we have as part of the prime growth subscription and the small case portfolios and the recommendations that we have?
Right. Yeah, we have our own customers asking whether these would be unique. So prime growth I mean, under prime growth we have prime stocks. That's not the only thing. There are a lot of other products, but prime stocks is one of them. And prime stocks is just a list of recommended stocks from across the universe, across the market universe. So it's simple bottom up stock picking. There is no theme in prime stocks. So you could have a consumer or a capex capital goods stock out there. Whereas Prime Minister's Financial Disruptors is a theme. And like I explained to you, the universe of the theme, this is quite restricted. And these will be the universe that will qualify to come. And these are weighted portfolios. Whereas Prime Stocks is just a list of recommended stocks that you can pick based on what is suitable for you, what you already hold, etc. Right? So with financial disruptors, the theme is limited. Of course, they may be sometimes one or two stocks that are also part of prime stocks. That's inevitable because if it's a good stock and it fits both the criteria, they'll be out there. But this is a managed kind of a portfolio with a limited theme. Prime stocks is a list of recommended stocks across the universe.
Okay, thanks. And there is also a question about recommended allocation. I think the recommended allocation from a investor's overall portfolio size, they'll be different for these two different portfolios. Bhavana, for the ETF portfolio and for the financial disruptor portfolio, do we have any kind of ballpark recommendation as to what a person's allocation should be?
It's hard to have very specific allocations like that because it depends on each investor's portfolio. But the financial disruptors, because it's thematic, don't go very heavily invested in that. Like maybe 10% of your overall portfolio should be fine. The ETF portfolio, it cannot be the only portfolio for your goal because it's not asset allocated. So, keep it to say less than 30 to 40% of your portfolio, of your investment. It
Okay.
can be the passive allocation maybe to your. So, if you're trying to look at an active passive combined, it can be the passive allocation to you in your
Okay.
overall investments.
Shrikant, I think there was also a question on time frame of these portfolios, so I'd just like
Yes.
to
Yes. Please.
address that.
Please.
Like any other equity portfolio, these are long-term portfolios, so a minimum of 5 to 7 years is the time frame. But it's not a buy and hold strategy in this 5 to 7 because we will be making changes as appropriate or as we deem fit in the portfolios. So there will be changes to the portfolio, but you need to come in with a mindset of equity investing, which is 5 to 7 years, whether it's your ETF or your financial disruptors.
Okay. I have a specific question about financial disruptor portfolio and some stocks, whether it will be considered. I'm trying to try this. Anand asks, in your disruptor small case, will you also consider small size PSUs and PSUs that may be getting privatized like IDPI, just to name? What are the
Okay, so
thoughts?
becoming a private bank from being a PSU is not really disruption. It may be disruption for that bank itself. It's disrupting its own self, but it's not disruption to the ecosystem or to the business. So that will not be considered.
Okay. Okay. Um, take that away. And another question that we had is that in terms of returns data, I mean, Bhavana presented some returns data, backtested data for ETF. Financial disruptors, it's not possible to produce such data, right? Do you want to comment on the past performance returns data with you?
Right. So there are two things, about historical data. Most you'll see small cases put out historical data. Backtested data is different. Backtested is where you apply, the changes that you make. But even historical data per se, um, historical data is based on the present portfolio. So I have a portfolio and I have hindsight bias. I have built the portfolio to ensure, to see that its track record is good thus far. So giving a historical record per se, won't really help in terms of showcasing our own skills, right? So we don't, in general, even at Prime Investor, our own stock portfolio, our own mutual fund portfolio, only now that they have crossed, 2 years, that we even give out a historical, data. So historical data of a portfolio that we did not manage, to us doesn't make much sense. And two, this is a portfolio built for the future. Some of the stocks in the portfolio, if I might say, don't even have a long listed track record. Some of them no, have a reasonably new listing, so it's not even possible for us to give a historical data. So we are giving the present data, and at small case, you'll be able to see from here on what is the performance against the benchmark.
Okay. Let me take a couple of questions, or at least one question. Madhavan Bharadarajan asks, once subscribed, I'm sure we'll get access to the stocks, but is it necessary to compulsorily invest in the portfolio? Not really. You can subscribe to a small case portfolio without making a active investment. Obviously, you get to make money only when you make an investment. So you can subscribe now and choose for the right time to make the investment in the small case portfolio that you've subscribed to. And CABGSK asks that mutual fund portfolios with allocations like 7+ years, our ultimate wealth portfolio, are currently available on Prime Growth. They are also available on Prime Essentials package. Whether these options will be available going forward in Prime Growth? Absolutely. These portfolios will be our main staple portfolios, our main staple recommendations that are available in Prime Investor. They will definitely be available in Prime Investor. That's our core offering. That's why that's what you primarily get for your subscription. So they'll definitely be available. Rajashekar Shanmugavel asks, any future small cases in pipeline with only risk theme and not sector wise? There are small cases in pipeline for the future. What shape, form they will take, and what theme, strategy they will adopt. You know, uh, do you guys have any idea about that? I don't think we have any idea at this time, right?
We'll let in our investors know once we have them.
Okay,
Yeah, it's
definitely.
on
Obviously,
works. Yeah.
obviously, we'll let
We'd
people
like
know.
to have them, but yeah, let's see.
Yeah. Captain Whittle asks, I'm already a subscriber to the core and satellite portfolio. Thank you very much, sir. And like the concept a lot. Absolutely, thanks. At this point of time, do you recommend to stagger the investment or do a lump sum investment? I think Bhavana briefly touched upon it. You want to add anything to that, Bhavana? The question is, do you recommend to
No, if you've already
stagger
made.
the investment or do a lump sum investment in the core and
No,
satellite?
no. It's best if you stagger the investment. I mean, even especially given this current market that we are seeing, is because staggering will give you more buying opportunities, right, on dips. So yeah, it's best to stagger, not lump sum, especially in this portfolio.
Okay, cool. Um, yeah, Pushparaj from Mangalore wants to know, Prime Investor Financials Disruptor Small Case, will this grow at 25 to 50% over the next 5 to 10 years? If he's talking about aggregate growth, I think that is quite possible. If he's talking about annual growth, that will be a very tall order.
Yeah.
Anything to add, Vidya?
Yes, it's exactly what Srikanth said. On an absolute growth, if the index grows, there is no reason why they should not grow more than that. But annualized, I should, really alert you to something interesting here, which is in the context of, because you asked about returns. We do think, the Indian economy, as agreed by a lot of economists now and by a lot of equity researchers, very seasoned people, the economy is going to struggle to grow at 7%. 8, 9, 10 will be, out of bounds at all order. That's the shape that our economy seems to be taking for various reasons. That can be a separate topic of discussion at Prime Investor, if some of your Prime members. But if that be the case, it is very important that you all tone down your return expectations from the market per se. The good news is that the financial space, typically when the market grows, the financial space grows, it's high beta, so it grows more than the market. So you can be assured that the financial space, and especially if we think this is a concept that disrupts and grow and as a high growth opportunity, should grow better than the market. But please be very wary of the fact that when the economic growth is not going to be very sound over the years, do not expect market to deliver very high returns unless we are having true disruptors, disrupting companies like US does, right? If India has, then that will be a very different story.
Thanks. View SSV asks if the core and satellite will be all equity. I think the answer is yes, right, Bhavana? We don't have plans to include debt ETFs into that mix.
No. There's no plans. It will be an all equity portfolio. If anything, we might take tactical, sometimes shift to cash if markets call for it. Otherwise, no, all equity.
Okay. Vidya, about the financial disruptor portfolio, or I'm not sure what the context is here, whether it's about the financial disruptor or the ETF portfolio. Portfolio change allocation tactically based on cyclical performance.
I think he means the ETF portfolio, likely.
ETF portfolio, okay.
Rather than saying cyclical performance, the satellite part of the portfolio can change based on opportunities in different sectors or different strategies, right? Sometimes value might do well, sometimes growth might do well, sometimes a certain sector might do well. So you will see changes there. Yeah.
Okay. And uh, CAVGSK asks again, on staggered investments, every fall of 10% or any specific percentage we should consider buying. Any recommendation on what we consider a dip to, dip your toe in?
Would you like me to take that question?
Yeah, please go ahead. Sorry.
Yeah. Yeah. See, typically when there's a very steep market fall, we do alert customers, and I think it's now that you have asked, it'd be a good idea for us to even alert our small case investors on steep market falls. But
Good.
we don't typically do an absolute 10%, 15%. I would strongly recommend that you read our, equity outlook for 2022. It's available on PrimeInvestor's website. We did the same in 2021-20 also. We give levels of the Nifty based on valuations, based on PE. So a PE based market, PE based call works better than simply saying a 10%, 15%, because a 10%, 15% correction may still make the market in the bubble zone, and there may be a deeper correction. So you don't know how much more money you'll be putting in. So like Bhavana was mentioning in the beginning, that the averages, long-term averages are at close to 18, and we are at 20. So we're not way away from the average. So we are not at a very, at a danger zone, etc. So that is the kind of call you need to put, you need to decide in general in investing. So two things in ETF portfolios, you simply do a SIP. If it's too confusing, when it comes to financial disruptors portfolio, these kind of market falls, looking at market levels will help. And you could possibly, if you have a lump sum in mind, split them into like 4 parts and see, if you can put one fourth on these dips on different market levels. So that would be
Okay.
my suggestion.
Okay. But a nice comment from CAVGSK just to keep us going. Thank you, sir. Thanks for your appreciation. We appreciate your appreciation, really. Thank you. And Rajashekar Shanmugabel comes back with a question. We have already invested considerable amount in prime stocks, which are part of small case too. How can we avoid repetition? I don't think we have any overlap between the two
Very,
lists.
very, very limited. Very
Very
limited.
so
And
that should not really be
you
a
could
concern.
just count with a finger. So, yeah, that's not the case, really.
Okay. I think Ravi asks this question. I think you addressed this question, but any elaboration to address the specific concern?
What percentage of fall do you normally recommend as a dip or a fall? That's the same answer that I gave for the staggered investments. Look at
Yeah.
the market levels. That would be a better way. Once you read our equity outlook for 2000, you will get an idea of, what we are talking of, what levels of the Nifty, and how we arrived at those levels fundamentally, not based on technicals. So that would be a better way to guide yourselves rather than 10% or 5%. For example, if a market is so sound, a correction may just be a 10-15%, but that 10-15% can bring valuations to lower levels. Or a correction might be even a 40-50%, like it happened in 2008, right? So these absolute levels don't help. Let's go with PE valuations.
Um, Sakti Kumar and Samyapa asks, how are the small case units allocated based on real-time market rates or something similar to It is based on real-time market prices of the stocks involved. When you place an order, it is executed pretty much immediately in the brokerage of your choice. So it's not like end of the day unit allocation like mutual funds do. Maybe take one last question. We are well past our 1 hour mark. Can you consider creating more small cases that include PI stock recommendations, aligning with specific themes? It's a lot to invest in small cases than in stocks for less informed investors. We are open to any suggestion that will make communicate our recommendations and will help investors invest in our recommendations easily. Um, Creating fashioning small cases is a separate kind of a task compared to creating something like prime stocks. So tying the two together might not be trivial, but Vidya, do you think that is something that we can do possibly? Vidya, you're on mute.
We could definitely look at that, but for the benefit of our own prime growth investors, in all fairness, I think simply building a set of stocks from prime recommended stocks into a portfolio um, would just kind of duplicate the whole exercise, and your own subscriptions too. So in fairness, we would like to keep it unique. Like I said, if there are good stock recommendations in our prime list and they are part of any theme that fits there, definitely they would definitely be there. But if you're talking about making it easy for you to invest and automate a review, then it's something that we have to consider and see how it works. I mean, if we can have something in prime growth and help you execute it elsewhere, we would definitely want to consider that at some point. Yeah.
Okay, let me answer a few quick questions and then we'll wrap this up. Madhavan Varadarajan, will we also get rationale for stock selection in the financial portfolio? We have an article as to what's the philosophy that we follow for selecting stocks in financial portfolio. Whenever we do a rebalance, we will communicate to you as to the nature of the rebalance and some reasoning that went behind the rebalancing or addition or deletion of stocks. We'll definitely communicate that with you. Kiran Bansali has a list of questions about making lump sum overseas investments today because of the RBI, directive. I would just say, I would urge a little bit of patience there. I think RBI and SEBI are working on that particular, limit, and pretty soon it should be opened up again. So let's just be a little patient and more avenues. I mean, let's not jump to alternate avenues and conclusions at this point of time. Do you see the markets hitting 20K? I think he's about talking about the Nifty index in the next 2 years. Uh, your guess is as good as ours, I think. And Madan Mohan has why ETFs are not direct equities in current satellite small case. If there is no debt ETF involved, what is the advantage we have in ETF than direct equities? I would just answer it with one word: diversification. You invest in a lot more stocks with an ETF than with a direct ETF investment. Kaushik R wants to know if you will come up with a PrimeInvestor app. Uh, we hope to. Things are still in the works. Sri Ram Prasad wants to know if our portfolio is not weighted much in financial, can we consider this financial disruptor portfolio? Vidya, I'll let you have the last word on that question. And
Definitely, you should. And if you don't have much of financial stocks, this is a good way to start your financial portfolio because we are talking about growth in the future.
excellent. Thank you all. We have really shot past our timeline. Please take a look at primeinvestor.smallcase.com or primeinvestor.in/smallcase. Prime Investor subscribers get a good discount for investing in these small cases. This might be a bad time around the world, and we are very conscious of that. But at the same time, we have to plan our life and our financials, and we have to react to market events. And the current market situation might present us with an opportunity to get into these portfolios portfolios at an appropriate valuation. So please check these portfolios out, and I think you will find them, well constructed and very reasonably priced with discount for Prime Investor subscribers. So please take a look at them and please let us know what you think. Thank you, Bhavana. Thank you, Vidya. Thank you, everyone. Thanks.
Thank you.
Thanks, everyone.